Thanks everyone for attending. I think everyone that's here today or at this time still deserves a bit of a round of applause. By my calculation, we've all been here for about 9 hours, and I'm obviously the last talker for the day. A lot of people would actually see being given the last talk at a gold conference after 9 hours as a bit of a tough job, bit of a poisoned chalice. Might even make you sort of question your friendship with Kerry, given I've known her for so long, and we've been such good friends over the years. But I'm a bit of an optimist, and I actually look at this and think it's a bit of a free kick for me for three key reasons. One, and I'll list them in order of importance. One, there's actually a few charts and slides and information that I can share, which I'm pretty excited to go through. Other people haven't covered it yet today, so I hope that'll actually make people feel pretty optimistic that we're in the right space being investors in this asset class, even if in particular for US dollar investors it hasn't been a great few years. The second reason I'm optimistic about this talk is there's actually been a lot of great insights that have been shared by other keynote speakers. I'm actually going to touch on some of those points that they've already made, but me being the last one speaking today, I'll get to take a lot of the credit for stuff that they've already done. And last but by no means least, as you mentioned at the end of this speech, unlike all the other ones, everyone gets to have a drink. So that's another win for everybody in the room. So the purpose of my talk tonight, can I have a clicker? The title of the talk that I wanted to give was, as you can see there, Who Knew Gold is in a Bull Market? And the reason I chose that as a title is there's obviously been a lot of pessimism, particularly in some parts of the mining space overseas, and particularly for people when they look at the US dollar price of gold, which has obviously been in pretty much in a corrective phase for the last 6 years. But if you actually look at the price of gold in the majority of countries where people consume gold, and the World Gold Council does they actually do a chart of this, or that they calculate this, gold's actually been doing really well for the last few years. So the chart that you can see here, if this clicker works, the chart that you should be able to see here, there you go, is what the World Gold Council call the consumer gold price. And it basically looks at an average of the gold price in the 6 largest consumer nations that buy gold. So it includes the US, includes obviously India, Turkey, a couple of other countries as well. And you can see that yes, there was that sort of corrective period from 2013 onwards, but basically since the end of 2014, for most consumers of gold on the planet, gold's actually been doing really, really well. And that last little spike higher that you can see at the start of this year is predominantly driven by the collapse of the Turkish lira and the increase in the gold price for people buying gold in Turkey. Even in Australia, gold prices have been doing pretty well the last few years. One of the reasons why our mining industry is doing much better than some of their global counterparts. Obviously, the picture in US dollars, and that's where I'll spend a bit of time talking about, is nowhere near as attractive. So I'll go through the current situation and some charts on how bad it's been, how bad the current situation is, which is actually a good sign for people looking to deploy capital now. Sorry, that just kicked in. Why personally I'm so optimistic on the outlook for gold. Share a few warning signs for investors. That'll actually dovetail in with some of the themes that Sean talked about earlier, where he was talking about just how strong the outperformance in financial markets is right now. And then finish with a little bit of a word on Australia, and actually that'll reinforce a point that Don made this morning talking about the building risks in our housing market. So if you look at obviously the US dollar gold price over the last sort of 18 years since the turn of the century, obviously amazing run to 2011, pretty ugly since, but even though the chart doesn't look great, if you were to look at that, you could sort of still see kind of a bit of a reverse head and shoulders pattern. It sort of still looks like the bottom was probably in at late 2015, around $1,050 an ounce. And even though it hasn't been great, going since then, prices are still higher, even though sentiment is now back as low as or as bad as it was about 3 years ago. So a few illustrations of how bad sentiment is. Chart that you can see there shows gross short positions on data from the CFTC. So very, very much just an illustration of managed money investors, hedge funds and the like, and how heavily they have started betting on gold prices falling. The net positions now, net short has been for a few weeks. That's very unusual. You can see how fast the situation has deteriorated this year and how aggressively hedge funds have gone short gold. Again, it's obviously been one of the reasons why gold prices in US dollar terms have done very poorly the last few months, but it's actually a pretty good sign. The other interesting thing about this is that this is not limited to gold alone. So the next chart that you can see actually shows gross non-commercial positions, not just for gold, but for 10-year Treasury futures and also for the VIX, or the volatility index. And you can see that chart goes back to 2005. You can see just how serious the short position in these contracts are, traditional kind of safe haven type investments, and also how fast the situation has deteriorated this year. So again, for anyone that's been long US gold mining equities, or anyone that's been long the US gold price, this has been pretty painful to go through. But for people looking to deploy capital now, it's actually a very good sign from my position. Probably sort of indicates that the path of least resistance might still be lower short term, but these are good signs for longer term investors. Another chart, this was one that I actually ran the numbers on this a while ago. Obviously there's been a huge divestment of gold out of ETFs in the last few months. And the chart that you can see there goes back nearly 10 years and shows sort of rolling 3-month flows into and out of gold ETFs over, as I say, the last decade. And the last 3 months that we've gone through, with the exception of 2013 where gold really fell out of bed, and also with the exception of late 2016 after Trump won the election and equities and risk assets rallied much to everyone's surprise, the last 3 months have seen the fastest pace of gold outflows from gold ETFs on record. So again, from a sort of sentiment point of view, or as an illustration of where things are at, it's a troubling sign for right now, but a good sign for the longer term. Gold coin sales and sort of minted products. This is from the US Mint, Nick Ledd's, one of Nick Ledd's many fantastic charts. And basically at the start of this year, coin sales for the US Mint were basically back to pre-GFC levels. Certainly at our business at ABC Bullion, to provide a bit of, I suppose, colour and data specific to our company, on any given month, if we do $100 of turnover with just our retail business I'm talking about, roughly $85 to $90 of that might be sales, and $10 to $15 of it might be buying metal back. By the end of last year, and this was partly because gold wasn't doing much, it was partly because Bitcoin was going crazy, that number had almost got to 50-50. So if we were doing $100 a turnover, $50 of it was selling metal to clients, $50 of it was buying metal back. So again, a real illustration of how depressed demand had become in the market for Western investors. This is US data, but it's reflective of Australia and certainly even in parts of Europe as well. If you think the gold space has been bad, spare a thought for some of the gold miners. Sean, I remember your talk earlier today, you had a great chart on the sort of outperformance of the miners that have hedged versus I think you showed these two indexes, GDX, or these two ETFs, which GDX represents the sort of larger cap gold miners, GDX is the junior miners. And it's incredible. If you think that it's now 10 years basically since Lehman crashed, so 10 years that we've been in this era of zero interest rates, quantitative easing, aggressive central bank stimulation, both of these products have been around for basically 10 years, yet investors in them have really, really done very poorly. So from inception, GDX has lost 45% of its value, GDXJ has lost 65% of its value. And in fact, if you'd bought in, like if you put 10 grand into GDXJ when it started, about 18 months after you'd put your money in, you were up $5,000. So you're up 50%. From there, you've lost almost 80% of your value. So it has been a disastrous time for people investing in this space, but for people wanting to buy an asset that's unloved, or an asset class that's unloved, these are the kinds of signs that you'd start to look for, even if you're not going to necessarily go and pile in straight away. A couple of other signs to highlight how bad sentiment is. Vanguard in July made an announcement to change the name of their precious metal and mining fund to the Global Capital Cycles Fund and to downweight their gold exposure. That's, again, typically the kind of thing you'll see towards the end of a bear market. I've managed to work, before I got into precious metals, I've been an investor in it for 15 years, but only been working in it for sort of 5. Before I did that, I worked for sort of large financial institutions and worked at 2, which launched products right at the top of a cycle. So I worked for Bankers Trust when they launched the Technology, Info, Media and Entertainment Fund in the year 2000 to take advantage of the NASDAQ boom. 18 years later, that product, which has since been rebadged, is still down 50% from people that put their money in. So think of the amazing changes that technology has delivered over the last 18 years. If you bought into the technology bubble 18 years ago, you're still down on some of those investments. And I worked at AMP, who in 2011, pretty much to the month that iron ore prices topped or peaked, launched a global commodities fund, which got absolutely smashed within the first 2 years of launching as well. So the fact that Vanguard are basically taking the gold or the precious metals out of their funds, and even the name and therefore the marketing of their products is probably a good sign that this correction has largely come to an end. And this last one, which I thought was really interesting, I don't know if anyone in the room is familiar with Ritholtz Wealth Management. I would say that they are probably the best users of social media to grow their private wealth advisory business in the United States. Nearly all of their key employees have very, very prominent Twitter social media profiles. They constantly blog on absolutely everything. And look, they're smart guys, they're decent guys, they're not gold haters either. A couple of them don't really like it, but they're not, I wouldn't call them gold haters per se, but one of their employees, Ben Carlson, he wrote a very short blog just over a month ago now, which was titled, "What if Gold Dies Out with the Boomer Generation?" And the essential point of it, I won't read the whole thing, was that millennials, both as consumers in their day-to-day life, but especially as investors, have no interest in gold. They're interested in technology, cryptocurrency, you name it. And is there a chance, basically, that as our, I suppose, my parents' generation die out, who is going to be interested in gold anymore? And basically, what are the implications for the price? Now, as I say, if you actually, not that I'm going to read every word of it, but he even did say, look, gold's been a great store of value for thousands of years, you name it. So he wasn't totally poo-pooing gold, but no one would write that blog when gold's at $2,000 an ounce. No one would even share that, feel comfortable throwing that out there for public debate in an environment where the asset is in a bull market and performing well. This is exactly the kind of thing that you sort of kind of throw out as a bit of a thought bubble when sentiment is completely depressed, when prices have been doing very poorly like they have or fairly poorly like they have in US dollar terms for some time. So all of those things are a sign of what's been happening the last little while in the gold space, which is, leads me to be fairly optimistic about what the future and the next few years are going to look like. So why are we so optimistic on gold? Main reasons are all the core reasons or the core benefits of owning gold are undiminished. So it's highly liquid, zero counterparty risk. Everyone in the room pretty much understands that. It's tangible. It's simple. Anyone can own gold. I think that's one of gold's greatest attributes. It's uncorrelated to equities, tends to do very well when equity markets fall. They haven't fallen much really for most of the last decade, but bear markets in equities do come. So gold is going to come back into its own when that is likely to happen. And it has a history of outperformance in periods of financial and or economic turbulence. Now, any investor, be they a retail investor, a consumer in the Middle East or parts of Asia, or institutional investor managing billions of dollars, can look for those attributes in any number of asset classes. There's plenty of assets that have some of those attributes, but none have all of them as simply as gold does. And Sean made an interesting point. Sorry, Sean, I really liked your talk, so I'm going to keep referring to it. Made a point about the outperformance of financial markets right now and how basically mainstream investors don't care about gold, and that's absolutely accurate. But when the market does turn, and it will eventually, those institutional investors are likely to come back towards gold. Now, it might not be, they might not buy bars and coins, they probably won't. They might buy an ETF, they might just buy a futures contract, they might buy gold mining equities. But the point is, when gold starts to outperform, they're going to feel pressured not only by their peers, but by their clients to own gold. And the reason for that, if I can make a comparison to something like Bitcoin, obviously Bitcoin was the investment story of last year. Everyone wishes they owned it, if they're being honest, but nearly no one did. right? And certainly at an institutional level, basically no institutions were in crypto last year. Now, if you were an investor and you had your money with an institutional, you had your money with an insto, you might have asked them about it, but you wouldn't have really been angry that they didn't own it. The market's unregulated, questionable liquidity, real question marks around the governance and security of ownership. So you would understand why they, as a fiduciary looking after your capital, would say, well, look, that's a bit of an investment fad, but it's not for us with your retirement savings. But if there's a serious stock market correction, or if inflation takes off, or currency crisis or anything like that, and gold is the asset that starts outperforming, an institution's going to find it a lot harder to explain to their clients why they don't own it, be it in gold, be it in pure bullion form or in mining equities form. What are they going to say? Oh, sorry, we didn't understand that gold was a liquid market. We didn't understand the back testing. We didn't know that it outperformed in periods of financial stress. They can't possibly make that argument because the data is so clear, the history of the market is obvious to anyone. So when the market turns, you're not just going to have, I suppose, a few retail investors piling in, which is what's happened in the crypto space. You'll have a lot of money come towards gold, and that'll be, that'll help push prices a lot higher, in my view. In terms of where we are now, probably people have seen a chart like this, or I know pie charts are horrible, but that's the best way to see this illustration. Gold and gold mining companies are still comfortably less than 0.25% of institutional portfolios. In Australia here, self-managed super funds have been by far the largest growing segment of the market, not the largest segment of the market, but a huge area of growth. But they still have comfortably less than 1% of their assets in gold. Institutional wealth in Australia at this point, they have some gold mining equities, but there's not a huge amount of gold there at this point. So there's a lot more buying power than there is selling power. Interestingly enough, if you look at non-gold market participants who are surveyed about gold, Bank of America Merrill Lynch do these surveys every now and again, and according to their latest surveys, gold is now seen as being more undervalued than what it was at the start of the GFC. So that's a really good sign. Like back then, gold prices were closer to $800. Now they're around $1,200. You can see, I'm not sure if this pointer works. Yeah, it does. So you can see here in 2011, a lot of the people that they surveyed thought, geez, gold is really expensive and probably overvalued. And they were right. Gold was, $1,900 now. Now here we are closer to 1,200, and you can see that is the largest reading in terms of the percentage of people saying gold is essentially undervalued. So that's another good sign in terms of where we are. Bar and coin demand, I sort of touched on this a little bit. It's obviously not been amazing, certainly not at GFC levels or anything like that in the United States and Europe, but it's still fairly robust. The numbers are, by no means shocking. There's still solid support there, 300-400 tonnes a year. China and India are seeing the same thing. We haven't had a repeat of 2013, where there was over 2,000 tonnes of bar, coin and jewellery demand, but we're still comfortably above 1,500 tonnes a year, which is basically 50% of all the gold that's been pulled out of the ground in any given year. So there's still plenty of demand coming from there. Central banks are buying. This is a bit of a repeat of one of the charts that Bron put in his presentation today. They're buying 400 or 500 tonnes a year. So there's plenty of demand for gold. There's no issue with that. And look, they're likely to continue to buy for years to come, even though I know Bron said they should sell it. Poland added gold to their reserves for the first time in 10 years. And actually over the last 5 years, central banks have bought more gold than they have US treasuries. They've actually as a whole, started decreasing their holdings of US treasuries. And as you can see from the chart there, really since the GFC, they've started relatively aggressively adding to their gold reserves. So these are all good signs for the market. Where I think it gets particularly interesting is in the fact that there are really very clear risks that are building in financial markets and in the economy. So one of the easiest ways to see that, and I reckon this is probably, in 21 years of working in financial markets and in gold, probably one of the best charts I've seen. What it shows is the valuation for bonds and equities combined for 15 of the largest developed markets in the world. So a lot of times people say, oh, the market's expensive, the market's cheap. Which market are they talking about? Are they just talking about the US stock market, or are they just talking about Japanese bonds? You're not quite sure necessarily. And it's hard to get a picture of the lot. This chart as I say, it grabs the 15 largest developed market bond and equity markets combined, and it basically looks at where valuations are relative to history. And what you can see is where we were here. This is basically to the end of 2000 and or about halfway through 2016. Valuations for markets as a whole have never been more expensive. So from that perspective, if you think that gold's uncorrelated to equities, which it has been, if you think gold tends to do well when markets turn, you'd like to think that we're approaching a point, even if we're not there yet, that gold is likely to outperform in the coming years. Another one that's interesting is a bit of a retail poll I came across recently. Gallup did this in the United States, and it shows the number of people, or the number of respondents to their survey, mentioning the economy as one of the major issues that's plaguing the nation. And you can see that right now, the number is basically down to about 10%, which is about as low as it's ever been. This is the GFC. Basically, everyone was worried about the economy then. 86% of respondents were saying the economy's stuffed. Right now, no one's worried about it, which is pretty much exactly where they were just before the GFC hit and exactly where they were just before the NASDAQ crashed in September 11 and the recession back then. So, it doesn't mean a recession's coming tomorrow, but it's the kind of sign that you'd see when one's probably not too far in the future, when the economy's sort of fairly late cycle. This is an interesting one as well. Right now, there's a chart on that I saw on Twitter today. The average spread that investors are demanding for buying BBB bonds or bonds of even lower credit quality is the lowest it's been in 10 years. So the amount of protection, essentially, that they're seeking for taking greater risk with their capital is as low as it's been in a decade, basically back to GFC levels, even though we're about to have a huge spike in corporate debt rollovers over the coming years from less than $400 billion to over $1 trillion, basically, for 3 years running from 2020 to 2022. So there's a clear funding crisis building in emerging markets. Maybe it will start to spill over into some US corporate market as well. Again, a definite warning sign. This is the other one that's the really interesting one, and it shows the US yield curve going back to 1985. And what you can see is whenever the chart goes below zero, it essentially means that short-term borrowing costs have gone above long-term borrowing costs, which is pretty unusual, and almost always, not always, but almost always, a recession follows soon after. And you can see that basically here, happened in 1990, again in 2000, again in the GFC. You can't see it on this chart, but there was also one in the middle of the 70s. And you can see that we're basically back to that point again. Now, interestingly enough, if you look at what's happened this is one of the reasons why I think gold's set for some pretty solid outperformance in the next 1 to 5 years. If you look at what's happened the last time the yield curve, or the last 4 times, sorry, the yield curve got to these levels, gold almost always outperforms. So this following table covers this pretty clearly. And what it shows is those 4 times the yield curve's inverted. So September 78, January 89, February 2000, and February 2006. Then it shows the 1-year performance, the 3-year performance, and the 5-year performance for the stock market and for gold after each of those occasions. So basically what that's saying is from September 1978 to September 1979, stocks went up 6.6%, gold went up 67%. The 3 years on from that period, stocks were up 13%, gold was up 109%, and then over 5 years from September 78 to I guess that would be September 83, stocks were up 60%, gold was up 90%. So if you look at this as a bit of a historical illustration and think that it's some kind of guide to the future, then gold basically if you look at the average 1-year performance, it's 4% versus 19. Over 3, it's really interesting, -7 versus +47, and even over 5 years, +28 versus +70. So gold is, if you think history, as I say, is any kind of guide to the future, these are pretty good signs for gold building, even if that relative performance between gold and equities is not just ready to shift. It's probably going to shift fairly soon. And before I wanted to finish, I wanted to spend a little bit of time talking about Oz and the situation here. The chart that you're looking at there is a chart of Australian residential housing measured in ounces of physical gold. So it goes all the way back to 1969, So basically the entire period that the world's no longer been on the gold standard. And the first thing that stands out is, particularly if you live on the East Coast, I know prices have corrected in Perth a lot, but the first thing that stands out looking at this chart is over the last 45 years, the price of housing in gold hasn't changed. So it's a pretty clear illustration that gold's protected its purchasing power. Back in 1969, you needed just under 400 ounces. Today, you need about 400 ounces as well to buy the average house. Obviously, depends if you're buying an apartment or a 5-bedroom house or whatever, but this is just the median house price. But what you can also see is very clearly the markets move in cycles. So by the start of the 80s, when gold had sort of completed its last great bull market, you needed less than 100 ounces of gold to buy a house. By the turn of the century, you needed almost 600. So if you look at sort of where gold is now relative to the average house, you'd think that it's cheaper than what the long run average has been. So the long run average has been about 300. Right now we're at 400. If we have a genuine crash in Aussie housing and a rally in gold, maybe we drop the whole way to 200 or so, which would suggest substantial outperformance in the gold price. But the key point I wanted to illustrate here is just how significant this housing problem is going to be for Australia in the coming years. So Don mentioned it in his talk earlier, that the average Australian, or that the value of the Australian housing market is around $7 trillion. My view is that in the next 4 years, the country is essentially going to see a year's worth of economic output wiped off the gross assets of Australian households. And where I come up with that number is if you just take a $7 trillion baseline, and a lot of even mainstream economists now who normally like to talk things up are suggesting that peak to trough will see a pullback in nominal prices of around 15% for housing. Like, it's not going to be the same in every state and with every house, obviously, but if we take that as an average, that's basically $1 trillion right there wiped out off the value of housing stock, just 7 trillion, and take 15% off that. There's two other factors to consider though, right? The correction will likely take at least 3 to 4 years, possibly even a little bit longer. So if we have inflation of even 2% per annum for 5 years compounded, you add that on top of the nominal wealth that's been lost through that 15% decline, and you're talking the better part of 25% that's wiped off the value of Australian households or their net worth. And the other thing as well is you've got to sort of measure this versus what people's expectations have been. Now, on the East Coast where I live, people's expectations when it comes to Aussie housing, particularly in Sydney, is that prices would go up at least 10% every year. That's kind of the baseline that people get into their head. So the average house in Sydney is around $900,000 right now. So without thinking about it, people are sort of going, oh yeah, if this goes up 5-10% per annum, my net worth's just going to go up 90 grand a year. So as a nation, even if we've factored in 5% house price growth into our heads, which is really conservative compared to what the performance has been over the last few years, that's $350 billion of wealth per year we thought we were going to get, that we're not going to get anymore. Instead, we're going to see possibly the better part of $1 trillion of nominal wealth wiped out, and even more when it comes to the real value, given the impact of inflation over 4 or 5 years. So the implications of this are incredibly clear, provided the thesis proves to be correct. The Reserve Bank's absolutely stuck. They can't raise interest rates in any meaningful way and may well have to cut them. It's a real disaster. For all the problems the Fed caused in the US, they at least had 500 basis points of easing up their pocket when the GFC hit 10 years ago. We're at a record low cash rate and our housing correction's barely started. So interest rates are going to stay low and possibly go even lower here. There's going to be substantial pressure on the Australian dollar, and given our banks have an almost obscene weighting on the ASX, financials are over 40% of the index, the ASX is going to find it very hard to perform well, and the average Australian super fund, given their weighting to Australian stocks, is also likely to suffer. Gold, even if it holds its value over the next 5 to 10 years, is likely to do incredibly well on a relative basis. So even though a lot of the slides and data that I've shared today show it's been a really hard market to be into for the last 5 to 10 years, I think the next 5 years are going to be a lot of fun. Thank you.